morning, everyone, and welcome to the webinar. Before we begin, our NAIOP Vancouver President, Jason Kisselbach, will say a few words.
Good morning, everyone, and thank you for joining us for the second webinar in our fall series focused on the investment market. We've been thrilled with the participation for these webinars so far, so thanks for joining us. Before we begin, I wanted to mention what is upcoming at NAIOP for the remainder of the year. First of all, the Commercial Real Estate Awards. Last night, we hosted a small event at the Terminal City Club to recognize the winners of the 2018 and 2019 awards, 8 categories, and our developing leader. And we're putting together a short video on the event that will be available in the coming weeks. Our final breakfast webinar in this series is in early December and will be focused on the office asset class. We're also launching our 21st annual cost of business survey, which is our scorecard to rank the local municipalities based on the cost and timelines to construct an office development. That will be included in the November 16th edition of Business in Vancouver, and we'll give an update on that at the start of our next fall webinar. Our Government Relations Committee continues to advocate on behalf of the local commercial real estate community on important initiatives, and we will provide updates via our Government Relations update emails. Our developing leaders are working on launching a mentorship program to connect young professionals with leaders in our industry, and that will be launching in the coming months. And finally, we have our annual general meeting where we will provide an update on our strategic plan for the upcoming year and nominating our new board positions. So lots happening before the end of the year. For more information on this and past events, please visit the NAIOP Vancouver website or follow us on social media. Finally, I'd like to thank our sponsors. Without their continued support, we would not be able to undertake these important initiatives on behalf of the local commercial real estate community. I would now like to turn the presentation over to today's moderator, Jarvis Rouillard, Vice President of Acquisitions and Leasing at PCI. Jarvis is also past president of NAIOP Vancouver and currently serves as our National Director on the NAIOP Corporate Board. Jarvis, over to you.
Thanks, Jason, and that was a great effort on my name, so I appreciate that. Welcome, everybody. Thanks very much for joining us today. My name is Jarvis Rouillard. I'm with PCI Developments. It's my pleasure to be able to present NAIOP's 2020 investment panel this year. And what a year it's been, obviously, and continues to be. I'm sure you guys all have double screens right now and maybe checking on the election, but yeah, what a year. Challenges have been posed that we thought would never be faced in our lifetime. So this year's panel discussion is going to be intriguing, to say the least. We appreciate all of you for tuning in virtually, and I look forward to meeting up with all of you in person once we're through the other side of the pandemic and it's safe to get together so that we can share and celebrate all the good work and the exciting projects we're working on. So first up, I'd like to briefly introduce our panelists. So I don't know if the panelists, if you want to put your cameras on, that'd be great. All 4 of our panelists are very talented and very knowledgeable in the investment sphere, and they're all going to bring a different lens to this discussion. And I'm really appreciative for all of you spending your time to come and share your thoughts with us and the viewers, so appreciate that. Firstly, we have Megan Henselwood, Manager at Investments at Lotus Capital Corp. They're a Vancouver-based real estate investment management and asset management firm that invests across the country. Mehdi Shokri, Principal at Avis & Young's Vancouver office and a key player within their capital markets group. Amanda Payne is Director of Corporate Development, responsible for acquisitions and market intel at West Group Properties. They have a diverse array of developments across the Metro Vancouver region. And then finally, calling in from sunny Regina, Saskatchewan, we have Luke Schmidt, Vice President, Director of Real Estate Investments with the alternative investments arm at TD Asset Management. Formerly, some of you may have heard of it was Greystone. TD has a really large investment portfolio, in particular across Canada and growing further abroad, and including some very significant investments in Metro Vancouver. For example, TELUS Garden, along with some larger mixed-use developments in Surrey and Burnaby, notably King George Hub, which I know a little bit about, and the city of Lougheed, amongst many others. So, welcome and thanks for joining us. How are you all holding up?
Good.
I'm sure we'll spend more time looking at virtual maps of the United States than getting sleep in the last 36 hours, so this should be fun. But all I can say, that what's going on down there, I hope democracy prevails whichever way it leans. And I don't know about you, but I would suggest it felt really good last night. I went home, grabbed my Canadian flag, gave it a big hug, told it I loved it, appreciated it, even though all its imperfections. And I didn't have to wear a mask or no social distancing required. So that was nice. And I highly suggest it. So let's get right to it. Mehdi, you and your team at Avison are able to track investment activity in detail across the region. So we talked about this. It'd be great if you could give us an update on some of the material transactions that have happened since NAIOP's investment panel convened last November. And then hopefully from that, we can start diving into emerging themes from kind of just pre-COVID, what happened, where people were at right in the first kind of 2 months when COVID hit, and it was like a paralysis, and then what's happened since. So do you want to take it from there?
Yeah, no, absolutely. Thanks, Jarvis. I'll probably just maybe from first half of this year is going to be probably the theme, because the back half, I think we were all feeling like the momentum was there. Nobody had a clue what was coming. And maybe compartmentalize some of my comments to the first half of this year. But, as we've tracked the first half, the investment activity here has definitely slumped in 2020, probably the lowest level since 2015. We had about 84 deals valued at about 1.5 billion completed in the first half, which doesn't include, when we track these numbers, any multifamily sales, commercial land, or multifamily residential, but I will speak to some multifamily sales as well. So this obviously was a significant departure from the dollar volume recorded in the first halves of the previous 4 years. That being said, the deal velocity in the first half of 2020 remained comparable to the previous years, and actually was the fourth highest number recorded on record right now. In terms of just asset class and dollar volume, industrial investment at 644 million edged out. The office acquisitions about 629 million, multifamily sales at 620 million, and retail transactions totaling 223 million in the first half of 2020 again. Clearly industrial was already showing momentum prior to COVID and led in terms of the number of deals completed at 44, which represented about 52% of the total deal volume in the first half of 2020. I'll speak to some of the deals maybe just quickly after some of these points that we saw kind of prior to COVID and post. Multifamily, as I said, we didn't track this in the numbers that I just gave you, but definitely another asset class that was trending favorably prior to COVID and since has been. Much like the industrial properties, the sales of the multifamily assets remained steady in the first half of 2020 with 30 sales at 620 million. Significant assets trading hands in Vancouver, New West, Langford, Victoria. So definitely a pretty robust spectrum of where the deals were happening. In terms of dollar volume in the first half of 2020, we did see a slight dip with 37 of those deals back in 2019, recording $734 million of a dollar volume. But that being said, obviously not a significant change. In terms of office investment dollar volume in the first half, we bring that 629 million, as I mentioned earlier, in the first half, largely supported by really three main transactions, being the Landing in Gastown and Crestwood Corporate Center and also the Glen Lyon Park there, both of which Crestwood and of course Glen Lyon was sold by GWL. And then retail, I'd say, again, not to no surprise to anybody right now, or even prior to COVID hitting, was really fell to the lowest level since the 2011 numbers that we were recording, with 25 retail sales completed in the first half of 2020. So definitely a dip starting off the year, and clearly not showing much better now going into the COVID period that I like to call it. So as far as deals though, what's been interesting, I'll maybe mention a few of the deals that were initiated pre-COVID and closed during COVID, like the Landing, Crestwood Corporate Center, Plaza 500 being another significant trade that finally transacted after being on and off the market for many years. Lake City Lands up on Lougheed there, which Amin Virani sold to Larco, of course, in February when it closed at 146 million, and also one that King said it sold on Spur Avenue and Meadow in Burnaby there for $51 million to a private Asian investor. Most of these deals, again, negotiated pre-COVID, closed just prior to COVID, some just during the heat of when COVID was starting. But what's interesting that I'm finding of late, of just some interesting kind of deals to note here of during COVID, were a couple of retail transactions, which I guess wouldn't have been the first thought as where we would see deals occur. So the one that probably initially made some waves was Celtic's acquisition, roughly 38,000 square foot mall there in Ladner Trunk Road, that the investor group sold for $64.5 million reportedly out in Delta, and that's Trent Square. Understanding of this asset by Celtic, who's really been primarily a condo developer, some mixed use projects, is that they had a long-term vision that this site was going to be master planned to effectively be a mixed use res site. Interesting, I'm also hearing a lot of news in that market around Ladner and Delta of other deals that are being papered right now with similar stories, retail with a longer term view with residential. And that just tells me that, some developers are starting to really gravitate to municipalities where they're seeing positive signs of trying to work together. So that one was an interesting one. Another one, again, was previously out in the market. Ivanhoe Cambridge quietly did this deal here with an Asian group, which was in Nanaimo and Woodgrove Shopping Center. So, reportedly, again, they bought 50% interest, roughly about $100 million. So valuing, of course, at $200 million there. I think, clearly an asset that is not in favor right now. So again, very surprising. I'm sure Ivanhoe is very happy to have seen that deal transact, and the buyer, I guess, has some very different ideas for what they want to do long-term with the site in the education space. And so we'll see how that plays out. So again, two really interesting deals that happened recently here in the last couple of months. I've understood that Onyx now, GWL's, a buyer of that in the office space, which is a good sign to show that, there's still some strong support for office, although that's been a bit of a mixed signal as to what really is transpiring and what the appetite is. And we've got some large office sites in downtown, so we'll see how that unfolds, but there's clearly probably a bit of a divide right now, but deals are happening. I know, Jarvis, you guys transacted there on 41st, buying the site on 41st there in Canby from Coromandel. Kingswood, again, during COVID, bought two buildings in Willingham Park. And then Slate's acquisition, I'd probably end off with in False Creeks, where they picked up from TrioVest. And I understand there's some probably connectivity between the two that was quietly, a deal that happened quietly. So again, deals are happening. I'm interested to see the back half, because I can tell you here from the perspective of Avison, we're definitely seeing a lot of paper getting out. Deals are being put under contract. Definitely a significant change from what I'd say was March, April, May, relatively speaking. By no means am I thinking that we're back to where we were a few years ago, but I'm definitely seeing a lot more activity, and paper is definitely moving. And it seems like there's a lot more quietly marketed deals, or things that are not necessarily right out there happening. And so anyways, I'll stop at that. And
Maybe, why do you think that is? Is that lots more being quietly marketed? Is that because people are in distress and need to get rid of these assets and don't really want to be seen as getting rid of them or selling, disposing at a price below what they bought for, or other things? Or is it just because of the uncertainty of market, you're going to go in, ask high, and see where it ends up?
Yeah, I think there's an element of everything you've just said, and obviously context is everything. The deals that I mentioned that had happened, like Investors Group and Ivanhoe, for instance, obviously those properties were out in the market. COVID really throws a wrench into retail, because nobody wants to sell a site, obviously, that's completely underperforming, and you want to have a better story if you're going to position that asset to sell it. But I think the reality is there's some assets that have been marketed quietly because you're not quite sure how to fix the problem, but of course had an expectation. And if somebody can try to come in there and structure something creatively, or just hit the price, then I think there's an element of, you don't really want to waste too much time blasting things out if frankly your expectations are still not too far off from where they were. I think there's also an element for sure that there is more motivation, but there doesn't want to be a perceived idea that you're really that motivated to sell during COVID, because the obvious question right now is why would you be selling retail, for instance, during COVID, or res land, for instance, as well. So I think there is an element of the optics of how you do it for sure is part of why I think some of these deals are happening quietly. And there's also just the element of there's some creative buyers out there who are structuring deals differently too, and making deals work where they frankly probably wouldn't have had those opportunities to even go into those discussions with vendors.
Yeah, and I think that's, so we've been involved in some of those deals where that's the way we felt in that particular instance. But yeah, that's great. Thanks for that market overview. Appreciate that. So, no matter what continues to happen across the globe, since the 2008 financial crisis through to now, our province, Metro Vancouver in particular, remain a stable bet, and pricing has reflected that over the years. So for those of you investing across the country and possibly globally, where do you see Metro Vancouver region positioned in a post-pandemic climate as it relates to investment? Luke, do you want to take a stab first?
Sure, and I'll answer your question with a question: why is someone in Saskatchewan on this forum talking about Vancouver real estate? And I think it allows, first of all, we're a national, international money manager, offices in Saskatchewan with our Greystone legacy, but main offices in Toronto, and now the world with TD Bank. Our clients are national clients, and our real estate is certainly invested coast to coast, 21% in Vancouver. We've been in Vancouver for a long time. We're a long-term buy and hold. We're actually looking at an asset, an industrial asset, where we consolidated some ownership and going through the original underwriting package that we still have from 1981. So we don't own all our assets that long, but we have a long-term perspective. And we're also indiscriminate. I think you have some local biases, perhaps. You know the market better than I do. We partner with the local groups, but we also bring a global view. And I think the same questions that are being asked about Vancouver is, where's Vancouver post-COVID? What we like about Vancouver, and I think, everybody is, and increasingly globally being recognized, is it is a global city. It's hard to make predictions short-term, but it is a lot easier to make medium, long-term predictions. What do we like about Vancouver? It's a city that, I guess maybe we'll start first. Canada is not known, or is known as a low population density country. That's the myth. The fact is Canada is one of the most concentrated populations in the world. By definition, almost all of our citizens live in Vancouver, Toronto, Montreal. And so our cities have great gravitational pull. It basically sucks everyone into the country, into those cities, and everywhere else. And I'm in Saskatchewan. I know this is much more sparsely populated. You then combine that with culturally diverse cities. So this isn't, two stats that aren't known. That's one I quoted. The other one, what's the most cultural diverse city in the world? It's Toronto. And by definition, that's foreign-born population. So Toronto has about 49% foreign-born. This would be ahead of cities like Brussels, Sydney. London would be in the mid-30s, New York mid-30s, San Francisco low 30s. Vancouver's right up there at 42.5%. So you combine those two aspects that many cities in the world, I think we're always trying to compare ourselves to New York and San Francisco, when in fact we're actually ahead of those cities. And COVID's going to affect every city, but the trends that have been in place in Vancouver and other cities like Toronto, yes, COVID's going to change it, but those trends are going to remain in place. And that's what's driving Vancouver, will continue to drive Vancouver, and why we like Vancouver.
No, that's great. And I mean, obviously the recent announcement by the feds with immigration, I think they're saying 160,000 additional immigrants are going to be added to the target over the next 3 years. So, and you got to think a good portion of those are going to be migrating to Vancouver, Toronto, and others. But Vancouver will get a good portion of those. So that also bodes well. Megan, what about you? Any thoughts on the positioning of Vancouver? Do you agree with what Luke said? Any other thoughts to add to that?
Yeah, I was going to agree with a lot with what Luke says. I think Vancouver's seen, as a safe city. to invest in. I mean, as you started out, our politics, we have some issues, but they're not too detrimental. So I think we're safe. We're an 18-hour city. I think we're building to that 24-hour city. We're getting close, and all that's seen as positive. I mean, I do think kind of post-COVID though, there's going to be a push to lower density. I mean, we see that now. There was the article today that came out with Toronto condos. People are moving out, so I think we're going to see a bit more sprawl happening. So in Vancouver, I think it's going to be Abbotsford, Langley, maybe Victoria, Interior, across the country, Halifax, Ottawa.
Well, that would mean you're well positioned in those tertiary markets or secondary markets, which is great.
We like to be ahead of the curve.
Okay, well, so previously conventional thought was that interest rate and cap rate spread was particularly narrow, especially in Vancouver. And so as you invested, you'd kind of hope the target was that rental rate appreciation would spur the performance of your investments. Do you still see that being the case? Given where we are today, or are investors now having to take a different view when pricing these opportunities? Amanda, do you want to take a stab?
Yeah, so I'd say from the West Group perspective, we actually don't do many outright acquisition income deals, but when we're looking at it, I'd say it's very dependent on the asset class. So, and what does that future of the asset class look like? I'll focus on multifamily and industrial. On the industrial side, I think the future does look good. I think that kind of narrow spread can maintain because there's such a low supply. The demand is there and it will continue, and especially with where interest rates are. And then and it's just seen by the banks as such a good asset type. So you're getting that very low rate. But on the multifamily side, we love multifamily, but I'd say it's more challenging. You're stuck with your rental rate increases. There's more restrictions, I feel every year. And it's also interesting because we've been doing some rent versus buy analysis. And when you look at, say, a 1-bedroom condo in some areas of Vancouver or North Van, let's say you can buy it for $550,000. You get it at 1.79% interest rate. Your total all-in payments are in the $1,500 per month range. That's cheaper than renting a 1-bedroom apartment right now. And I'm not saying that's everywhere, but there's pockets where I'm seeing more and more buyers who could only rent finding a way to scrounge up that deposit and buy that 1-bedroom unit because it actually financially is making a ton more sense for them. So I see multifamily as being a little bit more challenged in maintaining that spread, especially for the new product. We hear the purpose-built rental side, it's harder to push rents right now just because it's a lot more price sensitive, but the existing product, it seems easier and they're seeing the appreciation.
Luke, do you have any thoughts based on Vancouver versus what you're seeing across the country?
Yeah, I think Vancouver's always historically been expensive. It's been low cap rates. It still is. I think other parts of the country have caught up. So then that bodes well for Vancouver. Before you had to pay up for Vancouver. Now it seems, multi-res Toronto, trading in below 4% cap rates, are pushing into Vancouver. And what we like about Vancouver certainly is that income, I think in growth, but income security. And one of the biggest issues with income security isn't as much demand as new supply that can really kill a market. And land availability, you all know Vancouver, it's very tough, it's expensive, but also entitlements. Developers always complain, the entitlement process, everybody, is critical of the city. I'll take a different view that that's everywhere. Vancouver, Toronto, you go. There's certain cities that it is easier. Generally, they're not those global gateway cities. But that entitlement process, making it different, builds in an inherent supply constraint. You can, only push so many permits through City Hall, and if you're good at doing it, it really the cream rises to the top. It gives you a little bit of competitive advantage and builds in that inherent supply discipline.
Okay. Yeah, I mean, it seems to be it's the capital preservation versus the capital appreciation program in Vancouver, and then it'll be interesting. We'll get into cap rates and where we think those are going later, but yeah, that seems to be the trend, which everybody seems to be harping on now, which which is interesting.
Sorry, Jarvis. I was also going to add something to what Amanda said there, but I think with North Van as an example, I mean, the majority of the supply that's being taken away are actually older existing rental buildings to build new rental buildings, right? So there's kind of this inherent balancing act that's already going on naturally by the virtue of these developments happening. And I agree that there's condos, but at the same time, back to what Luke's saying, I mean, the entitlement process to get more condos specifically on the North Shore is also become more and more of a challenge, like anywhere else, but probably more even highlighted in certain parts of the North Shore. So I do think that pressure continues to, there'll be pockets where I think we'll have that competitive bid between an opportunity to buy something. Obviously, interest rates right now are spurring that as well. Versus renting, but I think long-term, to Luke's point, that the security of that income is pretty well healed right now.
Yeah, absolutely. In 2008, we saw many institutional investors with their hands tied due to investment or portfolio over allocation to real estate after a dramatic erosion of the equity markets. Today, we haven't seen that same circumstance, so there's a different playing field. Do you believe that a particular segment of the investment pool is going to lead the charge on commercial real estate investment through what we hope will be the final few innings of this COVID impacted economy? Megan?
Yeah, I mean, I think I'd like to look at more of the broader aspect of this, and I think it's going to be the creativity of landlords that's going to help us move out of that. I also think prop tech is going to be, a big help in moving forward, because we're all focused on, NOI preservation and, how do we keep what we have and how do we grow what we have. And so Lotus is, a big believer in prop tech. We're a significant investor in Nexi, and Shanor, our CEO, is on the board of advisors, helping bring that real estate investment perspective to prop tech. And one of the coolest things about Nexi is the ability to construct quickly. So recently they put up a freestanding Starbucks in 6 days. So what that does is, saves you cost, saves you time, and Starbucks can open and start realizing gains 2 to 3 months, in advance of a traditional build. And then alongside of that, it's also, sustainability, environmentally friendly. You're building off site. So I think it's stuff like this that's going to help us move forward. I mean, I think institutions are still going to be the ones that are going to be buying some of these bigger, core assets and pushing rates down. But I think in the longer term perspective, I think we as a real estate community need to focus on, how do we change and move forward with the economy.
Luke?
Yeah, I think certainly the denominator effect on the institutional side, when you look at March and when the equity markets decreased 20%, you can't ignore that. And certainly at the institutional level, there's rebalancing. So I think institutional capital, it's difficult for it to be active when our clients are going through a major rebalancing. Obviously, that's changed. That's a March story. We watch the equity markets. It's a signal for risk, but it's also a signal for where capital is flowing in. So we're actually seeing a lot of our clients now with equity markets bouncing back, actually now allocating, and it's all incremental. So, but when you aggregate that incremental, and millions of billions of dollars that move into real estate. So I think you are seeing institutions. We haven't seen it yet. I think everybody on the transaction side, office, too much uncertainty. Retail on the institutional side, I think that's almost a swear word. I think there may be opportunity there if you can be a contrarian investor. It's probably easier to wrap your head around retail than it is office. The risks are priced in, the risks are known. Office, to some extent, you don't know what the next 12 months are going to look like. And there's not really much leasing or investment market activity. And then industrial is probably on the other side where everybody wants industrial, is willing to pay for it. You're certainly seeing transactions at levels pre-COVID. We're looking more towards the development side there to get in at a reasonable cap rate, not paying where that capital is flowing through. Generally, if you go somewhat against those capital flows and not with it, you can find some opportunity.
Great, thank you. Okay, we're moving along, which is great. Still got a whole bunch of questions to get through, so we're going to keep working through. And now we're going to get into kind of the sectors. And I know we talked about this before. We're going to try and keep it to the investment perspective because there's all separate panels on industrial and office that we've all seen and all talked about, and I think we all appreciate the dynamics in those sectors. So just looking at it just from the investor lens, start with land. Are opportunities to acquire development land increasing with distressed assets? And if so, are we expecting to see a discount? Are there discounts out there? I know from our perspective that we've seen, there haven't been any discounts yet. And then also just kind of when it comes to land, on the strata side, just to think about and maybe comment on industrial strata, it continues to perform admirably. However, are you looking at office strata as an opportunity as you look to kind of build your land base? And where do you see land prices going in the next 12 months? Amanda, do you want to start with that?
Sure. So on the land side, on where we're seeing opportunities, I feel like we're definitely seeing more opportunities. I don't know if I'll call them true opportunities because it's still hard to make sense of the numbers to a degree when we're kind of pricing in the risk into our residuals. And I think vendors are still, they're kind of getting there, but not quite willing to come off what they saw a few years ago. And that's really where we're noticing that struggle. So unless there is that bit of distress or people just needing to sell, we're not seeing too much on the opportunity side by pricing. I do think it will come down because I'm seeing a lot of kind of product on the residential land side just stay available and not many people move on it. You've talked to many groups and we're all kind of in the same standpoint on what it's valued at. So I think that will change. Where we're seeing opportunities though is I think vendors are willing to be more creative. So it's building that time into deals. It's managing the risk in the deals. And then we are seeing success with that. But on the pricing side, it's still not where we like it to be and are very comfortable to be, but we're finding opportunities to get creative in the deals and otherwise. Industrial strata, we actually have never built, but I think it will continue to perform just based on where interest rates are and the demand in that marketplace. Office strata is kind of an unknown market to us from the West Group perspective. We like to build it to hold, but I think that's a tough one based on the uncertainty in that market and people wanting to invest in it. I would struggle to justify buying that right now, even with how low interest rates are.
Mehdi, what are you seeing on land?
I mean, the idea of distress has been talked about almost ad nauseum for the last 2 years. I feel like everybody I seems to think that there's going to be, the shoe's going to drop and there's going to be a bunch of, smaller developers or mid-sized developers who just can't deal with the payments. But I think as we're all seeing, they're kicking the can here with renewals on their debt and the debt keeps growing. And, naturally you're thinking, when is this going to finally be a deal? I'm not necessarily seeing, and I haven't been seeing, like I said, the last 2 years when this conversation really came up on the res side, a lot of distressed assets being sold. And to Amanda's point, I think part of the problem too is a lot of the assets that, let's call them, have pressure to sell, they paid too much in the first place, right? So they're trying to kind of really at best try to break even, and even that becomes challenging. So the idea of letting it go to a court order situation, frankly, you're playing with house money, so to speak. So there's really no motivation at some point to really do a deal, unless, which was something that I'm now starting to see more in those kind of instances, you get developers who just can't get construction financing. They got coupled that with the slowdown in the marketplace on the pre-sale side, and now it just becomes a question of, okay, how do we see a path forward in building this thing? And you're starting to find ways of potentially vending in deals, maybe back-ending promotes to see some of that capital come back in the land by virtue of losing kind of going up front. And, that's not necessarily something I'm seeing a lot of, but definitely that conversation is being had. And I'm, involved in a few deals that way where we're trying to get creative on how to, again, deal with the fact that they came in too high on the land in the first place, but try to make that up by developing the site. On multifamily rental sites, I'm definitely not seeing any, call it compression on land values. And I think it seems to be more or less a question of timing. I definitely think there are more groups who are willing to give the time to go through entitlement in a lot of cases where deals are happening to keep the land value kind of where we were pre-COVID. which I think, of course, there's value to that too. As it relates to industrial, echo the same things Amanda said, and office as well. So yeah, I'm not really seeing a ton of, I'd say, like I said, deals happening, but I definitely see a lot more flexibility on deal terms. So
yeah, it seems like flexibility and creativity to get deals done, pricing not coming off quite yet, if at all. Okay, well, let's just jump over to retail then. COVID's expedited wind up of weak points that already existed in the sector. However, there are strong performers as well. Are you seeing exposure in retail not previously anticipated now that is giving further cause for pause? Or are there opportunities to jump in and take a contrarian investment view? Luke, you kind of mentioned there might be an opportunity there before. Do you want to just maybe expound on that a bit?
Yeah,
opportunities out there on the retail side?
Yeah, retail, and it was beat up before COVID, and COVID, what COVID's doing in a lot of cases, just accelerating trends. And at least you're going to have headwinds in retail, but you can grasp what those are. And if you can see through that and buy at the right price, which you are seeing price adjustments in retail, and institutional capital is not going to be crowding you out there. I think to go to investment committee with a retail center, even if it's a 7 cap, 8 cap, that's a challenge versus, the easy one. I'm not saying this is us, but this is, capital in general, would rather buy industrial at a 4 cap because that's, very easy to present that. On the retail side, one thing where we are not in Vancouver, but you may be able to take these trends in our global fund, which we're starting up. We actually invested in retail pre-COVID, right before COVID. It was in Europe, essential retail, which we view that as somewhat being isolated. So essential retail is grocery, do it yourself. And we also viewed it as almost quasi-industrial, where these centers, when you walk through a Costco, you walk through Home Depot, they look very much more like industrial than retail. And they form really a critical component of those operators' distribution networks. So we view that as being somewhat isolated. We could get it at a high yield. And I think you're seeing that in Canada. The difficulty here is it's hard to get a pure play of those two. But if you could, have an angle of that, and we're seeing it in our portfolios, anything outdoor, rent collections, are in excess of 90%, and doing quite well in sales of those two sectors. So that's one where there may be an angle. And then lastly, I think if you can see through it and have a long-term perspective, retail is so beaten down in areas, and we're seeing it, power centers, where the retail center itself, cap rates are moving up, that on a per acre basis, there's industrial land selling just down the block more than what that retail land value is. So if you could rip up the leases and knock the building down and redo the zoning, it all sounds easy. But I think you're getting to that point at retail where you have some certainty and limit on your downside risk, if you can buy it right.
Great, thank you. We're going to hop, skip, and jump over to multi-res. So even when facing unique challenges brought forth by the pandemic, in part due to temporary government rental assistance programs, the asset class is proving to be a stable investment compared to other real estate sectors. So, Mehdi, you touched on it, just how hard it is to kind of get entitlements and build this stuff, given other challenges, existing stock, et cetera. And there's still a demand for it. So is there more room for cap rates to compress here? And are you, and I guess I'd look at all of you, are you looking to continue to invest in this sector? Megan, how about we start with you?
Yeah, I mean, Lotus, we're a value add player in the multifamily sector here in Vancouver. And I mean, we're still looking to add more. I think we've been successful by being able to create, livability and affordability within our units by creating, that condo quality feel. But, because our buildings don't necessarily have a gym or some of these new things, we're able to offer them, at significantly less than, your secondary and your new builds. So, we've been successful there. And I think there's still opportunity to buy those. But I think kind of in the same with the land, you still have a different view between the vendor who wants to sell it, those prices before that, we're, going to 2.5 caps on the value add stuff. That's making it a little bit more challenging. But I mean, for us, I still think that, as you mentioned, we had the government propping us up first with all these tenants, and that's kind of fallen away. So I'm curious to see as we move forward, if there's something new that comes in that helps some of these tenants, because it's not like everyone found a new job, at the end of September when stuff came away. I think we'll be okay in the value add sector, but I think it's, the new stuff, and kind of as we said before, I mean, financing is cheap right now. So I think we are seeing, more purpose-built rental being, built and going through, which is going to come up for absorption soon. And I mean, I see that slowing. We don't have foreign students. Some people have started to move away from the province. So, we're certainly, not going to meet the supply that we need, but I do think it's going to take longer to absorb that, especially the 2s and the 3 bedrooms that, cities are forcing you to build in these new products.
Perfect. Mehdi, if you're pitching a listing for a rental building, are you projecting cap rates to continue to decrease a bit, or hold still, or go up, given that we've got some temporary immigration and out-migration? I guess not immigration, but international students. It's a great point. It's a big component of the rental stock here that's kind of put on hold.
Well, I would say that it really depends on, if it's a site that's kind of building permit ready and you're about to go and have a building in call it 2 years, and sure, a lot of these factors that we're talking about, I think are relevant in terms of absorption and maybe the impact on some of the rents. But I think if you're looking at it as call it a built to core strategy as an investor, and you're cash flowing this, looking at it 10 years out, I don't think I would be putting cap rates any lower. I don't think I'd be putting them any higher for sure. I think it's basically we're at pre-COVID.
So if somebody had an income producing asset, top quality rental building right now, you're saying there's probably no discount if they put it on the market today versus a year ago or versus a year from now. You figure it's probably right around the same.
Yep. Yeah. I mean, there's a few deals that are already out there right now that I understand are going to be tied up pretty soon, because the bids have already come in, and there'll be good case studies for this point. But I mean, we're talking still sub 4, 3.5 to 3 3/4 kind of deals, right? So, and this is more newer building.
See, that's where I think about it, and I go, we just talk about capital preservation, and there's people are probably looking less at retail now and focusing more on industrial, multi-res, Vancouver. Is that going to create more demand that's going to drive the cap rate down? I think
I also think one thing we're maybe missing a little bit, and obviously as developers, Amanda, you could speak, and Megan as well to this, and Jarvis, but I think there's also there's this, we're maturing the multifamily landscape too. And I'm starting to see, if you really get into, call it things like even unit plans within buildings in certain markets, you see the assets that are really performing very well and still hitting numbers that you're going, wow, I'm surprised. It's because they've just figured out the right unit plans. No different than the condo market, when you had, inexperienced developers just building bad plans, and you're like, why can't I sell a townhome in North Van? They just maybe missed the mark, right? And that's not necessarily a knock on the developer. It's sometimes you just build the wrong plan at the wrong time. And Megan mentioned 2 and 3 beds. Well, ironically, in some markets, actually 2 and 3 beds the 3 beds are achieving better price per square foot than the 2 beds. So I think there's definitely you're kind of also trying to capture the right plan at the right time, and you can never necessarily hit all those marks. But generally speaking, I don't see really. And debt, of course, is a huge factor, like CMHC financing, which is again becoming more and more difficult depending on which market you're trying to get it in. Is challenging, and also adds some risk. So depending on the market, if CMHC is pretty comfortable with it, then you can factor different assumptions in your underwriting, right? So
perfect. All right, well, we're going to jump to office because, man, the time is moving quick here. Office. Very quick, downtown Vancouver versus suburban offshoots. Are you preferring one over the other? If you were to invest, say, 75 million in Metro Vancouver office next year, Luke, if you had 75 mil to do, which I'm sure you guys do in your back pocket, and you had a choice, what would you be investing it in right now?
Can you say neither? Again, somewhat to say office right now, is there's out of anything, it's probably the most uncertain. I think you're seeing it in the trades. I think unless you could get a material discount, and it was the type of location and building that never comes to market in Vancouver in normal times, I think that's where you might see some transactions. Groups that are always trying to get in Vancouver have it on their radar. not only is it low cap rates, but they just never sell these types of properties. And I think that's where you might see some transactions. There's not likely going to be any major deals on it, but it's just to get Vancouver office is difficult. And I think it'll have to have some term and some tenancy on it to see through that short-term risk in order to see something transact.
Yeah, I mean, I think having stable covenants and leases, it seems to me that there would be a premium for that type of product now to kind of get you through the next 2 years, with the view that the office market's going to come back, although we don't know what that's going to look like. Amanda, do you have any thoughts?
Yeah, I'd say I'm kind of in the same boat as Luke of it being neither, but if you made me choose, I would choose downtown, and the primary reason just being location and lack of supply. When I still look at like the suburban market just as a small node, I look at this one area where we own a lot of industrial sites at the 200th Street interchange, and there could be 750,000 square feet of supply of office just coming to that little node, which would take 5 years to absorb. And so in those markets, there's just so much potential supply. I don't like how that feels. Whereas at least if you can get, as I agree with Luke, like that rare office site or office building in downtown core, I would have to choose that one.
Okay, great. Industrial, Luke, you kind of touched on it. Very difficult to find income producing assets and development land today in Metro Van. Vacancy remains tight as ever across the region. Rents have increased exponentially in recent years after remaining stagnant for decades. So I guess, Amanda, where do you see opportunities to increase your allocation to industrial? I mean, you guys have a pretty good portfolio going. Are you looking at more, and where are you seeing opportunities?
It's tough. So I'll start with the land side. Very challenging. Like mostly everything we look at, all these values, it's not even about values based on what developers can pay, it's what owner users can pay. And so that's a really tough one to kind of compete against. If we're looking for opportunities, it's on the very challenged sites, or it's sites that are more speculative. And then maybe one region would be going to Vancouver Island. We're starting to see more product come available there at a pretty good price point relative to the strata values and to the lease rates. And you're starting to see some big players make moves over there. So if I was to choose a region, it would probably be Vancouver Island, where you're seeing some sites come available, and it has some of the highest actually industrial lease rates in all of Greater Vancouver. But it's really hard on the land side to make sense of it when it's just owner users having to pay what they need to get land. So that's tough. Income, again, we like to build it mostly, but I think there's hopefully some more opportunities there. Like we're looking at opportunities where you can get debt at a sub 2% interest rate on an income producing industrial asset. So at least I feel like there's still a bit of that spread there on the income side that you can make sense of for us. But again, we're more focused on kind of building it out.
Mehdi, I've kind of heard rumors out there that, and rightfully so, I mean, people are looking at their industrial portfolios now because it's been so stable through this pandemic. And, maybe they're struggling in other parts of portfolios or others, and that there might be supply coming to the market for sale in the next 12 to 18 months. Are you seeing that? Are you hearing that? Is that where there could be some opportunity as people who have been holding on to industrial for long might be bringing it to market?
I wouldn't say there's definitely a few key deals that I know that are under contract right now of sites that I think will surprise people if they close out. Why would they even consider selling? And clearly pricing is probably a big driver of that, and maybe having the view that these cap rates are probably at the all-time lows and rents don't have much more room to grow. So, but I don't think there's going to be by any means a lot of supply further coming into the market. I mean, interesting enough, there's like a couple deals that have happened are all fairly sizable ones. The one I mentioned earlier in the conversation with Larco on Lougheed was, more specific to their business of doing, film studios. So I think if anything, it's just going to probably be more or less the same story. A lot of you got to get creative with the site, and whether it's a type of use that you have or a business operation that you can maximize value out of the site. I mean, I'm still not sold on the whole stacked industrial story quite yet in many markets, although I know that's validating some sellers to move off of their industrial sites too, when you start to obviously add a lot more density than traditional industrial. But yeah, I don't see it. I don't see there being a ton more supply coming in, but I do see there being quietly, deals happening again where there's probably more of a story towards what the buyer and the seller and how they got to trying to transact, especially on the larger scale. And on the smaller side, I echo what Amanda's saying. I mean, the challenge will always just be owner users are going to outbid, and it's just going to make it impossible to look at it either from a development perspective or an income perspective. So, and I think that market is going to continue to still probably see more supply jump in that category, the sub $10 million market. I can see there being more supply there, but not so much on the larger institutional or side. Yeah.
Great. Thank you. Deal structuring. Have there been any kind of unique challenges? I mean, obviously there's a ton of challenges in trying to underwrite anything right now, but just unique challenges, both securing and closing transactions through the kind of pandemic and this, this crazy year. Are there any changes you've had to make to be successful either now or into the near future in your processes or in your deal structures that, you could share with us that, have helped you be successful in trying to execute? Megan, do you want to start?
Yeah, I mean, the biggest thing I could say is it's no human contact, right? Normally you look at something we buy across Canada, you get on a plane and you go tour it. You can't do that now. You can't talk to tenants beforehand, you can't see it. So, I mean, that's making it, incredibly difficult. We have closed on some transactions post-COVID and, it's helped along by, vendors providing all the information up front. Pre-COVID, you would get a little bit of it, and then once it's under contract, you get the rest of it. I think now it's all about giving the most information you can up front so that, you can underwrite it without seeing the building, without talking to tenants. And we're seeing more creative deals coming through. I think you're going to see, potentially more, vendor takebacks, coming in, or maybe people are staying in with equity. Amanda mentioned it, more time being put on these deals. So, at the end of the day, it comes down to, it's just, you can't see it. If you can't see it, I mean, virtual tours, they're great, but they don't replace the actual, tour.
Yeah, no, that's great. And, absolutely, totally agree with you. Luke, anything on your end, trying to structure deals? Anything unique that you've changed?
Maybe not deal structure, but just how we're doing deals. And I wish we could say this in Vancouver. We don't have any land banking on the industrial side, which is next to impossible. But we do in other cities and in Toronto. We've been land banking, and that put us in a position to really do some work with tenants and do some builds on the industrial side and even on the retail side. So we have some land positions at Hamilton Airport, and again, I think that's what you're going to see in Vancouver too. You're seeing it in Toronto is moving out to the periphery, outside of the core, but still as these cities grow, Hamilton has a big labor pool, one of the busiest cargo airports. And when we kind of took a position, nobody else is there. Everybody thinks you're crazy when you go that far, but as population grows, it fills out. Same thing happened in Bolton in Toronto. First person there, people thought they were crazy. There's never going to be any industrial there. And then you look what happens now. So we were able to, we've started 3 industrial builds through this, and we're actually, starting a retail build for Costco as well. The difficulty is a lot of the decision makers are in the US, so getting them, a lot of them can't sign the actual deal until they see the site. Getting them into Canada is difficulty. I think you saw some press on that. So it is slowed, but we're doing our best to keep that moving, and they desperately need it for their operations. A lot of these, if you're in any e-retailing, you're busy. Hamilton Airport, they said the volumes they're doing on cargo is like Christmas pretty much every day.
Holy smokes. Great. Well, we're kind of coming down to the last 5-6 minutes. I've got a couple questions left, so I'm going to try and fire through these. And if you can give me some quick answers. In hindsight, are there any changes you would have made to how you approached your business strategy at the start of this pandemic? Obviously, there was paralysis there. Are there any opportunities missed, overreactions, underreactions? Megan?
I think it was just thinking multifamily was going to, do worse than it actually did, and prepping for that. Could have spent time, looking at other things instead.
Good answer. Amanda?
Yeah, I'd say we still kind of pursued opportunities where they were, so I'm happy with that. But I think maybe we could have not paused for as long as we did, just in wait and see, because you know what, I feel like we fared better than we did. But again, who knows what this phase 2 is going to bring.
Luke?
Any debt that I rate locked before COVID, I wish I would have rate locked after COVID.
That's a great answer.
But no, nothing. I think multifamily, yeah, not that you could have reacted, but we were anticipating 50% rent collections. Like we thought that was going to hit. We underestimated CERB and its effect. But I think even if you made it, even if you saw what COVID, you had a crystal ball, there was really no market to transact. So, could you went and bought industrial knowing that it was going to fare well? No, because there's really nothing trading. So there's really no regrets through what we did through COVID and managing through, especially the initial months.
Maddie, what about you?
I'll probably just speak more from an operational standpoint. I think I would have liked to have been more prepared to operate more virtually. I mean, it's been part of our strategy to become more automated and think, a little bit differently from a brokerage lens and how to move. And the company definitely is taking a lot of initiatives in that regard. But yeah, I definitely wish we were a bit ahead of where we were planning to be in that regard.
And what about your clients? Have your clients been obviously like all receptive? I mean, you have a vast array of clients, or some as receptive to virtual as others, or?
They were in the beginning. I think as the first month or two wore off, yeah, I think we all became a little sick of doing things virtually, and we're all very eager to try to meet face to face, or always to get out of that virtual space. But to some extent too, especially talking to groups out of Toronto, it definitely, you found it was a lot easier to connect. There's more time obviously on the other side there to get people's attention and have conversations that, frankly, and you hear a lot from a lot of executives that when you're in the office too, you're getting a million people bugging you, and just little bits of time that get eaten away in the day take away from the opportunity for people like myself to chat with them as well. So, so there's definitely some benefits from the virtual, but I think clearly from a relationship standpoint, there's no doubt we're getting sick of, I think, the virtual meetings. It would be much nicer to be in front of them.
Okay, last question. Put everybody on the spot here a little bit. If you had money to spend, appreciating that you maybe want to save it for a rainy day, but you have to spend it today on a high quality income producing property, what do you think will garner the largest profit if you were to buy it today and sell it 5 years from now? So you got distribution center, industrial, AAA office tower downtown, suburban office building, grocery anchored retail center, or a multi-res building, brand new build. Amanda?
That's a tough one, but for the profit is where I really struggle. But you know what? I'm going to go with industrial because I think it's just a strong performing asset. And I think there's room for cap rate compression there.
Great. Luke?
Yeah, I wish I would have a different answer, but I think it really is industrial when you go through it. The clarity of a cap rate compression, rental rate growth.
Mm-hmm.
The only problem is I think doing it because everybody is based on the cap rate you're gonna have to pay. Like you say everybody loves industrial, but then you go and look at the price and it's tough to make the math work when it's a competitive bid.
I know I feel like a bit of a hypocrite saying it.
Yeah, there's a lot of industrial developers wrapped in their Canadian flag and jumping right now.
I would say industrial land though, maybe that's where, if you can find it right. Vancouver's always difficult because it's just so crazy, but I think if you can put a position and build to it and play off that cap rate, so not have to pay up on a cap rate, sub 4, and be able to build to a 5 or 6 on a land position. I think that's where, if you have that 5-year time frame, that's where you could do it. Vancouver again is always a caveat, very difficult to do it. Other markets a little easier.
I was going to say you might be dreaming there, Luke, but I agree. I think that's probably, if you're going to get any value out of it, that's probably the only way to do it right now. Megan, what about you?
That's what I was going to say, but I guess following kind of what Lotus we do, I would go to more secondary, tertiary, fine land, and I think last mile distribution for some of these, smaller, something on the island, something in the interior, you know, Hamilton, Halifax, stuff like that.
Great. Mehdi? You're a rich guy. What are you going to put?
Everyone thinks I'm going to be crazy saying this, but I actually believe covered land plays have always been a retail story. And there's a few people who have definitely figured out there's certain municipalities that, you know, in the next 5 years, there's going to be much more opportunity to do what's obviously already been out there with some of the REITs building on retail centers. But I think in Metro Vancouver, there's still more opportunity in that regard, and the cap rates are protecting on the risk side. And I actually think in 5 years, in a lot of spots, you're going to find people are going to wish they looked at some retail a little bit more optimistically, I'll put. So
very interesting. Great. Well, you know, thanks a lot. I think, you know, the takeaways I would say from this is obviously Vancouver's stable. There's not a lot of value add out there right now, given the kind of capital preservation strategy across the country, lots of capital chasing. But, you know, there are still opportunities out there, and you know, it's going to come down to working with the skilled management firms and development firms to kind of make it happen and squeeze as much return out as we can. So that's great. Thank you very much, the four of you, for joining us and sharing your thoughts. Really appreciate it. And that brings us to the conclusion. So to all the viewers, thank you very much for tuning in. And again, look forward to seeing you all soon. And I'll turn it over to Paul now to close it out. Thanks.
Thanks, Jarvis. And thank you to today's panel. That concludes today's webinar. And thank you for joining us. We hope to see you at the next NAIOP Vancouver webinar.